while using the inversion fair value gap model, you can trade the market with the most confirmation, having the order flow on your side. And in today's video, we'll dive deep into the model and how you can use it to win your next couple of trades. So that's what we're going to be doing today, talking about the inversion fair value gap model. So the first thing you need for the inversion fair value gap model is going to be you need a draw on liquidity. That's first and foremost. You can't just simply trade every inversion fair value gap model without having a draw on liquidity. It can be, a lower time frame one or a higher time frame one. It doesn't matter what draw on liquidity you have, as long as you have a draw. That is by far the first thing you need whenever you're trading this model. Number two is you need to have a bias. You can't just simply go to the lower time frame and expect every inversion fair value gap to work. I used to do this a lot and it just didn't work out because I didn't have any higher time frame bias, so I wasn't able to trade the right ones. So it helps you filter out which ones are going to work and which ones aren't. That's why a bias is very important. The reason I put the draw on liquidity though first over the bias, if you have a bias but you don't have a draw on liquidity, I think if you have a draw on liquidity on the lower time frame and you're aligned with the higher time frame bias, then it's important. It doesn't matter if it's higher time frame or lower time frame. But you need a draw on liquidity for me to be the most beneficial in my opinion. You need a low hanging fruit objective, or you need relative equal lows or relative equal highs, and you just need something to target. That's first and foremost for me. Another thing is you don't want to have no multiple fair value gaps in the price lag. So you don't want to have multiple fair value gaps in the price lag. What I mean by that is like having multiple, like a big expansion move. I'm gonna show you guys what that means though. But you don't want to have too many fair value gaps overlap. You don't have too many fair value gaps all in one price lag, because then you don't know which one to use for your inversion model. So that's kind of why I don't recommend having multiple price lags and using this model. I would rather use something else. But either way, it's gonna correlate to what? Number two, what is your higher time frame bias telling you? And you can use one of those fair value gaps and expect all the other ones to get disrespected. So you need to be in the right time elements no matter what, and you need to use time to your benefit, because time is something that it's very powerful and it helps the market move at certain times. So you need time elements, kill zones, macros, doesn't matter. So number 5 is going to be have a change in the state of delivery, no market structure shift needed. So you don't need a market structure shift when you're trading this, so that's very easy. And then I'm going to put overlapping PD arrays here with this one. So you can have an overlapping PD arrays. So what I mean by that is you have a BISI and then an inversion fair value gap created. That is what I mean. So on here, let's go show you guys an example here. So we're going to mark out the recent high and we're going to mark out the recent low. Hopefully these are all right. So yeah, and then we're going to drop down to the 1 hour chart. We're going to see if we can find anything here. A buy side imbalance. You can see there's no other fair value gaps here. And this is what I see right here. A buy side imbalance that got disrespected. And this is a perfect example of an inversion fair value gap model. This could be your next draw on liquidity. Low hanging fruit objective. This could be your higher time frame one, since it did come out there in NFP. But then here you can see there was no other fair value gaps in this price lag. Only baby one right here. Baby one. It's a small tiny fair value gap, but it isn't as big as the other one, this one right here. And then you can see that's pretty much it. During this whole price lag right here, there was only one fair value gap right there. This whole price lag, as soon as we got broken above here, then boom, we formed a new price lag. There was only one fair value gap, and then there's the second one. The second one was all the way up here, and I believe it hit a rejection block, and then eventually it started to move lower. We created it as an inversion. We tapped into it. We came back up later, and then eventually we formed another one, but then we formed another PD array after hitting the inversion fair value gap. We formed the sell side imbalance right here, and that should give you more confidence that you're bearish. Whenever you have that, this is what I mean by overlapping PD arrays. Now you have a inversion fair value gap, and then eventually it creates a sell side imbalance. Sometimes it'll be the opposite. Sometimes you're inside of a sell side imbalance, and then eventually you have a buy side imbalance that forms right below it, and then eventually you disrespect and you make it an inverse. So you have two overlapping negative or bearish PD arrays that are telling you that you are bearish. So whenever you have that, to me, that is perfect confluence that shorts are available, vice versa if you're bullish. So no, you have a SIBI above it, and then eventually you'll form a small buy side imbalance. You tap the SIBI, then you drop, and you make it an inversion fair value gap. I think that's the easiest way I can explain it, honestly, and I'm gonna try to go and show you guys that model. But here, I would drop down probably to the 5 minute and, look for time elements, of course. So this would probably have to be during the London kill zone. So I would probably try to take a trade here. As soon as we disrespect and we close below it on the 1 hour, where would that be on the 1 hour? So I would usually wait for confirmation to close. Some people don't wait for the confirmation to close. And, to me, it really doesn't bother me, but I usually like waiting for more confirmation. So right here at 3, so then we go back down to the 5 minute, and we can see here as soon as after 3 o'clock comes, we form another model here, which is to me looks like a 22 model. So we don't sweep liquidity, but we have strong displacement, form a sell side imbalance. And this is what I mean whenever you have multiple fair value gaps. You don't want to use like the inversion model, because this one fair value gap right here, you think this model right here becomes an inverse, but it's not. It's because again, you want to have bias and you want to have a drawn liquidity. Your drawn liquidity could be, this, where is it at? The other one down here, this could be drawn liquidity. Again, here, you don't want to use this because it gets disrespected and you think that's an inversion fair value gap, but then you have another one above it and this one gets respected. And then you drop, and then eventually you form another fair value gap here, and that is another sell side imbalance, and then you drop even further. This fair value gap right here, you don't want to be trading this. You want to be trading, like the first fair value gap. ICT always said this one up here, market structure shift, and then eventually, I believe, it would have been probably on the premium side. You can see that as soon as we tapped into a premium, and then we drop. That's why you want to use price lags, and you want to use dealing ranges. Your dealing ranges on the lower time frame to the higher time frame. I believe dealing ranges are very important to see, if you're overbought, if you're oversold. Just using the Fibonacci, on the 0.5, and I believe that's the best way to understand like which fair value gaps are likely to get respected and which ones are not. And of course, using the dealing ranges inside of the fair value gap, so the consequent encroachment, seeing how far you want price to go inside of the fair value gap for a bearish scenario here. I probably would have taken the trade as soon as we got to here because we had a market structure shift. We, bounced off of the sell side imbalance and the inversion fair value gap we created, and we have a longer time frame drawn liquidity down here. And it just looks like a market maker sell model here. That's bound to be completed. So I would probably take it right here. And again, it's in the premium side, so I'll be looking to short inside premiums, not shorting onto discounts. And then eventually my drawn liquidity would probably have to be something small like down here. That would be my first partial, and then moving my stop loss to break even. Boom, here. This is another example. We took out sell side liquidity. We formed a sell side imbalance. Again, you want to have your drawn liquidity if you're targeting or if you've already met that. So that's why it's very important. Since we met this drawn liquidity right here, you're switching the order flow. We took out all these sell stops right here. And we're gonna disrespect this right here. Then we have another big fair value gap, and then we have one fair value gap here. So we disrespect this. We took our sell side. Now we're gonna be reaching for buy side liquidity, and we know that. And as soon as we disrespect, we formed a buy side imbalance here. To me, that is a very strong signature that price is switching in the order flow. And then eventually we form another buy side imbalance, and boom. To me, that's telling me we're strongly bullish. So I would take the the long right here, put my stop down there and target this right here. Me, this wouldn't be optimized in my opinion since it is during the Asia session. I don't trade Asia session mixed with like central bank dealing range. So 20 o'clock to midnight is pretty much the session I trade for Asia. This wouldn't be Asia for me. I know some people do like 16 o'clock down here, 16 o'clock all the way to midnight as your Asia session as a quarterly theory, but I wouldn't use it in my opinion.